Well, in October 1929, the heart of American finance, the New York Stock Exchange, was a theater of chaos. The streets outside were filled with frightened investors, their faces pale as they stared up at ticker tapes rolling out numbers that made no sense. Fortunes evaporated in seconds. Men who were millionaires on Monday were broke by Friday. It wasn't just a financial collapse. It was the moment when America's faith in its economic system cracked. But from that wreckage, from the ashes of the 1929 crash, something remarkable was born, the modern stock market machine we know today. To understand how that transformation happened, we have to go back to the feverish years before the crash, to the roaring 1920s, a decade that was as glittering as it was reckless. After World War I, America was booming. Factories were humming, cities were growing, and ordinary people were discovering a new way to get rich, the stock market. The idea was intoxicating. Why work hard for years when you could make a fortune by owning a piece of a company? For the first time, millions of Americans, teachers, mechanics, farmers, were buying shares. It was the age of optimism. Cars, radios, refrigerators, modern inventions were transforming daily life, and companies producing them seemed unstoppable. Newspapers spoke of a new era of prosperity. Stock prices soared, and people began to believe that the market could never fall. Brokers encouraged everyone to buy on margin, meaning you could borrow money to buy stocks, sometimes putting down only 10% of the price. If your stocks went up, you'd make a killing. If they went down, well, no one wanted to think about that. By 1928, the market had become a casino. Wall Street was flooded with speculators, and the ticker tape could barely keep up. Crowds gathered in brokerage houses, watching the numbers spin, cheering like it was a horse race. The Federal Reserve grew worried. It could see the bubble. But the spirit of the age was unstoppable. Everyone wanted in. Even shoeshine boys were giving stock tips to bankers. And then it happened. On October 24th, 1929, Black Thursday, the bubble burst. Panic spread through the market as prices began to plummet. Within hours, chaos reigned. Investors tried to sell everything at once, but there were no buyers. The ticker ran hours behind. Rumors of suicides began to circulate. Crowds formed outside the exchange, their silence heavier than any words. The mighty machine of American wealth had seized up. By the end of that terrible week, culminating in Black Tuesday, billions of dollars in value had vanished. It wasn't just paper wealth. It was people's life savings, their homes, their dreams. Banks began to fail, businesses went bankrupt, and America slid into the Great Depression. It's hard to overstate how devastating it was. Between 1929 and 1933, nearly half of America's banks collapsed. Unemployment soared to 25%. Breadlines stretched around city blocks. The crash didn't just break the economy, it broke the nation's confidence. For many, capitalism itself seemed to have failed. The system that promised endless prosperity had delivered despair. But it's in moments of collapse that new systems are born. The 1929 crash didn't just end an era, it forced America to rebuild its financial world from the ground up. When Franklin D. Roosevelt became president in 1933, he inherited a country on its knees. He knew that restoring faith in the financial system was essential. His approach was radical for the time. If the market couldn't police itself, then the government would. Out of the wreckage came a series of reforms that would shape the stock market forever. The first major change came with the Securities Act of 1933. Before the crash, companies could sell stock with almost no disclosure. They could exaggerate profits, hide debts, or even fabricate assets. Investors were buying blind. The new law forced transparency. Companies now had to publish accurate financial statements, verified by independent auditors. For the first time, honesty became a legal requirement, not an option. Then came the Securities Exchange Act of 1934, which created the Securities and Exchange Commission, the SEC. This new agency was designed to be the market's watchdog. Its job was to regulate the exchanges, monitor brokers, and protect investors from fraud and manipulation. It was a revolutionary idea that capitalism could be both free and fair, but only if it was watched. Another major reform targeted the very mechanism of speculation, buying on margin. Before 1929, people could borrow huge sums with almost no regulation, inflating bubbles that were destined to burst. The new rules imposed strict limits on leverage, forcing investors to put up more of their own money. It made the system less explosive, but also more stable. Behind all these reforms was one goal: to restore trust. Americans had lost faith in Wall Street, and without that faith, the economy couldn't recover. The government didn't just change the laws, it changed the psychology of the market. The new system emphasized information, oversight, and structure. It was no longer a wild gamble, it was an organized machine. And that machine would evolve over the decades into the highly regulated, data-driven market we know today. But the transformation didn't stop in the 1930s. The trauma of the crash lingered, shaping how generations of investors thought about risk. For decades, the market was cautious, conservative. The wild speculation of the 1920s was replaced by discipline and research. Financial analysis became a profession. Universities began teaching new theories, like Benjamin Graham's value investing, and later the efficient market hypothesis. The stock market was no longer a game of chance. It was becoming a science. Technology also played a part. The ticker tapes of the 1920s gave way to electronic trading systems, computers, and now algorithms that can execute millions of trades in seconds. But underneath all that speed and complexity lies a foundation built after 1929, rules about disclosure, auditing, and regulation that keep the machine from spinning out of control again. Of course, it hasn't always worked perfectly. There have been crashes since then, 1987, 2008, and others. Each time, the system has been tested, and each time, new rules have emerged to make it stronger. That's the legacy of 1929, not just destruction, but evolution. It's worth remembering that before the crash, the idea of government regulating Wall Street was almost unthinkable. The market was seen as self-correcting, a perfect engine of capitalism. But the crash revealed a truth that still echoes today. The market is not a machine that runs on logic. It runs on human emotion. Greed, fear, hope. These are the real forces behind every boom and bust. When you look at today's markets, at the endless streams of data, the algorithms trading in milliseconds, the constant buzz of CNBC and Bloomberg, it's easy to forget that it all began in chaos. The order we see now was born out of disorder. The trust we have now was built from betrayal. Even the very concept of the average investor comes from that transformation. Before the 1930s, investing was a game for the elite. But the reforms opened the door to everyone. Over time, pensions, mutual funds, and eventually 401ks brought ordinary people back into the market. What had once been the playground of the few became the engine of wealth for millions. The modern stock market is, in many ways, a reflection of the lessons learned in 1929. Transparency over secrecy, oversight over chaos, information over rumor. It's not perfect, but it's resilient. Every time it breaks, it rebuilds stronger. And yet, the ghosts of 1929 still whisper. Every time a bubble forms, whether it's dot-com stocks in 2000 or crypto in 2021, those same human emotions return. The belief that this time is different, that prices can only go up, that risk has been conquered. History shows us otherwise. The machine may be modern, but the operators are still human. What's fascinating is how the crash didn't just change the rules, it changed our relationship with money itself. Before 1929, investing was seen as pure ambition. After the crash, it became a moral question. Should people be allowed to speculate with borrowed money? Should banks gamble with deposits? These questions led to even more reforms, including the Glass-Steagall Act, which separated commercial banking from investment banking. It created the distinction that shaped finance for nearly a century. The ripple effects went beyond finance. The crash and the depression that followed reshaped American politics, leading to Roosevelt's New Deal and the birth of social safety nets like Social Security. The idea that the government had a responsibility to protect citizens from economic disaster was new, and it began with the collapse of Wall Street. So, when you see today's markets, regulated, digitized, and globalized, you're looking at the product of that transformation. The crash of 1929 didn't just destroy wealth. It forced the creation of a new financial order, one that blends freedom with accountability. If the stock market of the 1920s was a Wild West, then the modern market is a city of glass and steel, structured, transparent, and built on rules forged in pain. It's the same spirit of capitalism, but tempered by experience. Every chart, every trading app, every quarterly report, every disclosure, these are the descendants of 1929. They exist because once, the world learned what happens when greed runs unchecked. It's easy to look back and wonder how they didn't see it coming. But the truth is, people rarely do. In 1929, as in every bubble since, there were warnings. Economists, journalists, even some bankers raised alarms. But optimism is powerful. People believed the good times would never end. That's the timeless story of markets, cycles of boom and bust, of arrogance and humility. In that sense, the 1929 crash wasn't just a financial event. It was a lesson written in pain, one that still guides us today. It taught us that markets need rules, that trust must be earned, and that every system, no matter how strong, is only as stable as the people who believe in it. So the next time you open a trading app or watch the Dow Jones rise and fall, remember, this entire machine, the algorithms, the regulators, the brokers, the investors, exists because of 1 week in October nearly a century ago. A week when the old world ended and the modern market began. The 1929 crash was not just a collapse, it was a rebirth. And from its ruins rose the most powerful financial system in history, a system that still carries the memory of that day when the numbers stopped making sense and the world had to rebuild them from zero.